The Morgan Report with David Morgan. Discover how to build and protect your wealth at themorganreport.com.
David Morgan with the Weekly Perspective for the week ending March 7th, 2025. Well, welcome back to Money, Metals, and Mining. As you know, I'm David Morgan, giving you a podcast every weekend with a wrap-up on the financial markets, focusing on precious metals, oils, and the stock market, trying to paint a macroeconomic picture for the concerns shaking the markets. This past week has been a whirlwind, and I'm going to break it down. Gold had another strong week, reflecting its role as the ultimate safe haven. Investors sought refuge in the gold market. Gold futures are up a very slight amount, closing out at $29.17 per ounce. If you're tracking technicals, the 50-day moving average is showing a positive slope, which indicates continued strength. Silver, on the other hand, was dipped for the week off about 0.75%, less than 1%, closed out at $32.92 per ounce. But silver industrial demand continues to increase, and more articles are coming out on the continued silver deficit. Furthermore, there's an article out by The Economist saying silver is the new gold. Pretty interesting article. Bottom line, it's a dual metal, industrial and monetary, at least according to The Economist. And there is more interest in the silver market due to its price ratio to gold. Moving on, let's talk about the oil markets. Quite some volatility in crude oil. It was a roller coaster ride last week. Early on, prices plummeted to their lowest levels of the year, with West Texas Intermediate crude dropping 2% due to escalating U.S. tariffs and global economic fears. However, news broke that the U.S. government is looking to replenish the Strategic Petroleum Reserve with a $20 billion allocation. This set oil prices rebounding, but the gains were capped as traders worried about how the tariffs might slow global demand. Stock market likewise was a rather wild ride this past week. If you own stocks, you probably felt a little bit of pain. The market took a hit early in the week after President Trump pushed ahead with the new tariffs on imports from Canada, Mexico, and China. This sent the S&P and the NASDAQ into the third straight week of losses, down 3.1 and 3.5% respectively. The Dow was off about 2.5%. However, by midweek, a temporary reprieve came as the White House delayed certain auto industry tariffs by a month. That was enough good news to boost General Motors and Ford up 7 and 6% respectively. The big event was Friday's job report. The U.S. economy only added 150,000 jobs in February, and unemployment ticked up by 4%. That initially spooked investors, but Fed Chair Jerome Powell calmed the nerves by suggesting there's no rush to adjust interest rates. By Friday's close, the market had rebounded slightly. The biggest market concerns right now are, of course, the trade tensions. The U.S. tariff war is back in full swing, and it gets on and off like a light switch. First it's on, then it's off, then it's on, then it's partially off. But we'll see where that goes. Economic data, mixed signals everywhere. While inflation remains somewhat controlled, weaker jobs growth is raising concerns about the true economy. Corporate earnings. Many corporations are cautious about their future earnings. Basically, we are in a recession. I'll stand by that statement, although that's not official. Uncertainty are surrounding trade, inflation, and businesses are holding back. Monetary policy, the Fed has been steady on rates, but they will be forced to cut if the economy slows down. Of course, the market has other ideas at times. And geopolitical developments, from defense spending in Europe to China's economic struggles. Global political events are influencing markets in ways we haven't seen in years. Looking at the dollar here from Squeaky Mouse, you can see it looks like a double top, and dollar may be breaking this neckline and heading lower. Time will tell. Trump definitely wants a lower dollar, and that will probably happen. So the interest rate thing really is up in the air. We'll have to wait and see. And Roden Manley, at Bullion Brief, points out how much stocks have dropped in the LBMA. And he says, of course, gold is off by a big percentage, and silver is the whopping one with 7,700 tons. or a whopping almost 13% compared to the end of December. So silver's been the bigger drain than gold, actually, and not too many people are aware of that. This tweet from the sovereign individual is interesting. There's literally zero reason to believe LBMA, and that needs to be stated every time they're mentioned. I'm not sure I agree with that 100%, but I am getting a bit of a laugh out of it. And certainly we don't know exactly what goes on. And I'm a little suspect on the audit of Fort Knox and perhaps the other facilities that hold gold, like the New York Fed. Time will tell. Meaning I'm suspect. I just really wonder after, even if the audit happens, and even if it's an audit, will it be the truth, the whole truth, and nothing but the truth? Frankly, I doubt it. Final thoughts. If this week's taught us anything, it's that we're living in an economic environment with rapid shifts and unpredictability. Of course, gold and silver are holding strong. Oil swinging wildly, and the stock market is searching for a direction. Many articles came out this last 2 or 3 weeks talking about an asset reallocation. I believe this is the case, which means you are going to see more and more change of asset classes moving out of the equity side and into the commodity side. I think that trend has started. I think it's not that perceivable. So it started in gold, as I said, well over a year ago, maybe even 2, that the run to gold has begun. And that started with, of course, central bank buying, and that continues. But this is kind of a stealth mode. Unless you follow the precious metals markets closely, you would not be aware of that at all. Certainly not reported in the mainstream financial media. Moving on from that, we're seeing, again, the volatility in the stock market. It's looking toppy to me. It looks like it's overdue for a correction. Buffett has stepped aside for a large portion, with over 300 billion on the sidelines. He could buy up the silver market 10 times over with the amount of cash he's holding right now. And I'd just like to end with, I hope you enjoyed today's episode of Money, Metals, and Mining, the weekly perspective from David Morgan. And remember, if you're going to buy metals in size, you might go ahead and reach out to us at support@themorganreport.com. What is size? Size is in the $50,000 range, US or Euro equivalent or whatever. We could probably get you pretty close to wholesale, not wholesale. You can only get that if you are a wholesaler, but you can do much better than the retail side. And but it has to be something of substance, because it is not your normal, let's say, coin dealer, which will sell you a coin, a roll of coins, and that type of thing. It's a different business. Work with a hedge fund that moves metal in size. But if you are in the market for that kind of an offtake, 50,000, 100,000, a million, 10 million, whatever it is, certainly would pay you to take a little bit of time to find out what the bid offer is and what we could do for you. So I'll leave it at that. I'll be back with you next week with another weekly perspective.